Welcome back to Politics Tonight, everyone. Thank you so much for staying with us. Tonight, we're discussing Nigeria's economic outlook and investors' confidence. And an economist, Kelvin Emmanuel, is on the program with me tonight. Mr. Emmanuel, like I said earlier before we went on that break, Nigeria's inflation is expected to rise to 32.63%. What are the indices for you?
So the major contributors to inflation, like we know, is food and energy prices. It doesn't help that most of our what forms our energy baskets, transportation and non-transportation fuels, which are transportation fuels are typically called white fuels. So you have the Jet A1, you have the aviation, automotive gasoline, oil, AGO, you have the premium motor spirits. Most of it is imported into Nigeria currently. It doesn't also help that for example, the largest commercial refiner in Nigeria, Dangote, is unable to source 100% of what is currently producing from Nigeria, is having to import some of that feedstock into Nigeria because of FSAs and because of commitments the production from Nigeria has currently. So we're unable to get the full comparative advantage we would have gotten in terms of lower energy prices from the energy basket from a commercial refiner that refines locally because of the cost of landing petroleum products into Nigeria and because of the use around the FX rates that we currently have. So that contributes a major deal to the prices of goods and services in the market today, which is why inflation keeps going up. I expect that, for example, at the 294th meeting of the Monetary Policy Committee next week, they're going to raise the MPR rate again by another 150 to 200 basis points. But then that tightening comes at the risk of you having the non-performing loan book of banks continue to go up above the weighted average that the central bank has set. The Financial Stability Department of the central bank has set banking supervision for the commercial banks in Nigeria, which will pose like a systemic risk because usually when non-performing loan book goes up for banks, it affects their total risk-weighted assets, which impacts on their capital adequacy. So these are the impacts, right? So on one side, it's good to tighten. On the other side, it increases the cost of capital, and it tightens the ability for banks to lend to the real sector, which will impact on production. So it's a tricky, and this is the reason why, despite all the progress that the central bank has made, the fiscal authorities need to come in to support the central bank by restructuring the economy. And my key critical areas are to raise revenue to GDP ratio, both for tax and non-tax, harmonize the taxes, federal, state, and local government, taxes and levies to 10, like the Presidential Committee on Fiscal Reforms has proposed.
All right.
It also.
All right. I mean, because you talked about restructuring, for ages now, we've been talking about diversifying from oil and giving more boost to exports. Why does it seem so hard to get the economy functioning at its best?
So, there are legacy problems that the country has. For example, the Debt Management Office came out with a statement earlier today that Nigeria's debt is currently around 97.8 trillion naira. Which is about $109 billion, if I'm not mistaken, and that the external debt stock is about 38 trillion of that. So your debt to GDP ratio is close to 40%, and the interest on debt is high. And if you look at the 2025 Appropriation Act, you see that you have debt servicing costs above 7 trillion naira for 2024. So there are legacy issues that the current administration met. So I'm a bit measured when I criticize the current administration because I have an understanding of what it inherited from its predecessor. It inherited a really, really, really bad position. When this government came in last year, they were unable to borrow money from the Eurobonds market. It's still difficult to borrow now because Nigeria has a junk credit rating. If you go to the Eurobonds market to raise money, you have to borrow at about 15% in terms of coupon, and you might not get any moratorium on that debt. Nigeria's country risk premium is over 17%, which is like the credit default swap rates that investors charge to price in your bonds. Nigeria is supposed to pay $1.2 billion in terms of coupons to investors next year. And so it's a very difficult situation. The president has a situation where he's asking, how do I fund the budget? And then the deficit financing budget is 48%. It's good the president is beginning to send the right message. For example, he announced that he's going to suspend traveling for one entire quarter of all his cabinet members. It's a good signal to Nigerians that it's tightening, but it's also important that he goes ahead and implements the Stephen Orasanya report that is proposed to reduce the number of parastatals from 262 down to probably below 150. It's also important that the president is able to reform the act that establishes the Bureau of Public Procurement, because there's a lot of procurement fraud in Nigeria, to reduce the cost of capital projects in Nigeria. So, I think the president is on the right track, but it's important for him to prevail on his Minister of Finance and Coordinating Economy to improve revenues and to empower him with the reforms that he proposed in 2023 to be able to support the Central Bank of Nigeria. Because if you leave all the weight on the central bank, if you don't increase food production, if you don't backwardly integrate energy production midstream, if you don't increase the amount of investment that goes into gas upstream to be able to raise more revenues, if you don't increase the number of oil rigs, if you don't reduce the amount of crude oil theft in Niger Delta, you place all the demand on CBN, and CBN will just keep raising the rates, to fight inflation, and that will completely damage the real economy, which is what we're seeing today.
Okay, so while we wait for the implementation of the Orasanya report, an improper perspective now, how do you think government can balance policies on exports while also diversifying?
So when it comes to exports, the question you have to ask yourself is, what's the ease of doing business in Nigeria? Companies actually able to produce. What goes into their production? I'll tell you. So, for example, a company, for example, that makes mayonnaise has to import egg yolk powder. It's not very easy to get soybean oil. Yeah, soybean oil is produced in Nigeria. Vinegar, has to be imported. And a company, for example, that manufactures drugs, for example, pharmaceuticals, they have to import. They have active pharmaceutical ingredients. So when you look at the supply chain for a lot of what companies produce for exports, you ask yourself, do you want to operate like a manufacturing model where you import raw materials and then you export finished products? What is going to be your comparative advantage? On the other hand, when you look at the National Export Promotion Council and you look at something like the Export Expansion Grants, the EEGs, the EEG program, for example, needs to be reformed. The situation where companies collect EEGs and then they sell it to third parties at a discounted rate is just not working. Situations, for example, also where the government gives EEGs to companies that are exporting raw materials, for example, soybean, sesame seeds, it's not working. The government needs to, reform that program to only give grants in terms of promissory notes that you can use to reduce your tax, to only companies who are adding value to raw materials. So, for example, if you're exporting sesame seeds, the government will not give you export expansion grants. Instead, the government will say, we'll only give you if you're able to process the sesame into sesame cake and sesame oil, which will give you more in terms of revenue if you export than if you just export the raw material. So these are the kind of structural amendments that the Minister of Industry, Trade and Investment needs to make to support, in terms of reforming industrial policy of the country, to support the ability to make more money from exports and give us a favorable balance of trade advantage.
Right, but in practical terms, what should government do to boost investment and ease the cost of doing business in Nigeria, and also bring down the cost of goods and services?
So the number one fear a lot of institutional investors have about coming to Nigeria is the exchange rate. There are three major things. They call it the basket that forms your forward guidance. And this is the reason why I've advocated for the Monetary Policy Committee of the Central Bank to have what they call the dot plot. Dot plot, a graph that enables the Central Bank governors and the Monetary Policy Committee members, which also comprises of the board that was appointed by the president, the Central Bank, to show where exactly they are in terms of if they are hawkish or if they are dovish. Hawkish means they are bullish on raising MPR rates. Dovish means they are bearish on raising MPR rates. So give forward guidance to investors on periods, on inflation, on exchange rates, and on interest rates. These are the three major factors that determine whether investors want to come into the country or not. Because investors are asking themselves, if I bring in $500 million to Nigeria today, if I'm going to take that money out in 1 year, where's the exchange rate going to be? What is the external risk of the exchange rate, of devaluation and depreciation of the currency on my internal rate of return? So if, for example, over 12 months, I make 25% on $500 million, is there a possibility that the risk of exchange rate fluctuations might be higher than the 25% return I make on my money? This is the most fundamental thing that we need to pay attention to. So it's the Monetary Policy Committee needs to give forward guidance, and they can only give forward guidance if they're sure of what the fiscal authorities are doing.
All right. Let's also bring in another angle to this conversation. The president has been traveling from one country to another, negotiating trade deals and signing MOUs. When should Nigerians begin to see and feel the impact of these travels?
So I'm under no illusion that it's going to take 6 months or 12 months for the president to turn the country around. He inherited a mess. That's the reality of it. He inherited a whole mess. It's going to take time, to take at least 4 to 5 years for you to begin to see the impact of the changes. Even if I expect him to make more changes, I personally think that his cabinet is not a full representation of the kind of reforms that and the results that he's trying to chase. And I think that at the annual review of his cabinet by the policy coordination team later in the year, I think in May, the president needs to look at his team again, critical sectors that will impact on his reforms and the results he's expecting. So I'll tell you, for example, that if you look at oil and gas, which is the bread and butter of Nigeria, and as much as we want to talk about diversification, oil and gas is the bread and butter of Nigeria. I'll tell you what. Despite all the problems Russia has with the world, sanctions, removal of Russia from the SWIFT system of banking that has over 12,000 banks, Russian banks unable to open LC, Russia Nord Stream 1 was destroyed, was placed on an embargo, Nord Stream 2 was sabotaged. Despite all the issues Russia has, Russia still generated $99.4 billion from oil and gas last year. So we need to be able to look at NNPC as a company, for example, and strip it apart. We need to get NNPC through reforms, take it to IPO, raise capital, invest in projects upstream and midstream. NNPC needs to become an operator so that they can rely less on joint oil agreements and production sharing contracts to be able to raise how much of revenue that is not encumbered they bring into the Federation, FX, stabilize the economy. They need to invest in floating LNG vessels. They need to invest in export pipelines for gas to be able to supply Europe with gas to raise revenues that Nigeria needs to stabilize FX markets and also reduce the budget deficit. Because at the end of the day, if you trace the history of the problems, economic problems we have, at the foundation of it, budget deficits. In the last 10 years, budget deficits has gone from about 16.8% to about 48%. And that's the foundation of the issues like ways and means that impacted on you having monies through QE that is not backed by assets or reserves, and that led to devaluation of the currency and all the issues we're currently having today. So it's going to take a while. It's going to take the president like 4 to 5 years to get his feet on the ground and be able to find a bearing to a level where the economy is fully stable, and they're able to say, okay, we have up to 4% or 4.5% GDP growth rate per annum, or unemployment is coming down, or we're able to get inflation back to 12 to 15% levels, and all of those very stable metrics.
But if you also look at the president's open door policy to investors from around the world, what's your impression about it?
Well, it's actually encouraging that the president is, when he was in Doha, he spoke to, I think, the business council, maybe the Chamber of Commerce, Nigeria Chamber of Commerce, about corruption in Nigeria and the fact that he's not going to condone it. And if, for example, there is any issue of any Nigerian official requesting for a bribe, they should personally come to him, to intervene and address the situation. It's a good development. It's very good that the president is, actively leading the charge on talking to businesses. He was in India. He spoke to businesses. Is selling the country. Because at the end of the day, the president is the country's number one salesperson and brand ambassador. However, I think the president needs to focus on critical reforms. He needs to focus on critical reforms because it's not enough for you to promise investors that Nigeria is ripe for them to come in. They have concerns, and if those concerns are not addressed, it's going to be difficult for him to get foreign direct investments to the levels where we had it 8, 10 years ago.